Today we're going to look at a couple of best playbook trade setups. And if you don't know where to get in, if you don't know where the high or the low of the day is, if you don't know where the round numbers come from, and you don't know what a peak formation, high or low, engulfment or pin hammer look like, then you don't want to miss this video. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. We've started the week off with some massive moves on the pound crosses as well as gold, obviously. Today we're going to go through step by step. We're going to break everything down. We're going to start with a blank chart and we're going to piece everything together. Getting a lot of questions about some very basic things, and we're going to cover those in detail. We're going to look at a couple of best playbook trade setups that essentially encompass everything that you need to know. And today we're going to go into depth and explain all that in one step at a time so that you can apply that to your own charts each and every day to hopefully make things simpler, keep you out of losing trades, keep you out of getting stopped out for losses, know when to identify the best times to enter the market, and then how to identify asymmetrical risk-reward opportunities so that you can start taking some of your money back from the big boys, the smart money, the institutions, whatever you want to call them. First, before we do that, I just want to say thank you to everybody for, again, a ton of email, ton of comments, a lot of great feedback, some screenshots. Some traders yesterday absolutely killed it on the pound and gold textbook setups. I mean, it doesn't get any better than that. If you do not have those charts broken down, made notes on, screenshotted, archived, video recorded, whatever you need to do, those 2 days show you pretty much everything that you need to know about the high and the low of the day, 3 push patterns, 1, 2, 3s, asymmetrical risk reward opportunity, and in the case of gold, not only 50 but maybe 250 pips, maybe 150 down and 150 up, all from 3 push patterns coming off the high and the low of the day. So let's review. We start off the day. Asia, 8 to 11 p.m. New York Eastern Standard Time. Again, whatever your chart candles are, Google the time you're at. These are the times when the market will move to either make a stop hunt, hit the stops, trap traders in the wrong direction, lock them in up high or down low, and then shift the market for 25, 50, 75, maybe more. But yesterday's high and low creates the boundaries of the box. We've talked about this before. Price is always in a box. It's always either up high, working a high, and it'll at some point lock in an upper boundary and then work its way back down to either make a new low of the day or to the low of the previous day or to the low of the week, whatever that may be. But again, in most instances, those timings will be the most significant window to help us identify when we're at a peak formation, high or low. So when the day opens, the question I always ask myself, am I inside or am I outside? Now, one thing I haven't mentioned or written on here is, of course, I always look at where is the money. And what I mean by that is what traders are in profit. Okay, there might be somebody long off the bottom from last night or short off the top from last night, even if it's only up 25 pips. The market may be working down before in Asia it goes back through the high of the day and triggers yesterday's high. And then understanding the psychology behind breaking these other boundaries from the previous day's high and low. That triggers other time frame traders into the market. It gets breakout orders into the market, maybe for that current day. It gets profit target orders hit. It can hit stop loss orders from that previous night or previous session. So there's a psychology behind that, but also understanding that in most cases, unless it's a level 2, day 2, a trend day, when they break one of those outer boundaries, in most cases they will often go 50 to 75 pips in some cases back against that triggered entry, because that in a lot of cases is enough to stop out most retail traders or to discourage traders from having too much size on their positions. If they're a retail trader and they're trading end of day and they trade the break of a previous day's high or low, they have a 1 bar stop, which is the previous day's high or low. And you'll notice in a lot of cases when these markets jam into a high or low, they reverse off those levels, and the first place they go is to the current daily high or low, and in a lot of cases continue to the previous day's boundary because they've hit stops, triggered orders, and now they'll work their way down to the other side to stop those traders out who are either end of day or in positional traders, breakout traders, again, whatever that may be. But again, understanding that there's money there. And throughout all that fractal movement, there's highs and lows throughout the day, which of course build up stops. But most importantly, yesterday's high and low, because yesterday's a great example of where traders think they've missed the move because the market's taken off and gone 50, 75, 100 pips, and they think I missed the trade. If you're not in the move, you need to re-understand that once they get to yesterday's boundary, that indeed may be where that market finishes its move and establishes the lower boundary for not only the day but for the session. And we're going to examine that in detail because we're going to look at how those markets over the next 3 hours form 3 push patterns and will often culminate perhaps in a 1, 2, 3, 3 bars, 3 pushes, jamming traders in down low, chasing the trend with their indicators before the market locks it in the next 12 candle window. And as we saw in gold, pins down and then boom, takes off and goes 175 pips, whatever it was. So are you inside or outside? Today's high and low of the day. Is the market working the high or is it working the low to go up, or is it just trading back and forth? Now, yesterday in gold, a lot of traders told me they thought that was a range-bound market. But indeed, if you go back and look and ask yourself, where was the profitable trade? We saw the sell signal from Friday after payrolls in the equities hour in the New York session. That trader was in profit. The market worked up in 3 pushes, and in that last hour of the Asian session, in 15-minute charts, again, 15-minute charts for your boundaries, went 1, 2, 3, just far enough to stop traders out at break even before locking that in with an engulfment, dropping down and then coming back and putting a pin hammer into the first mouse before dropping away and then adding another bear pin hammer before it accelerated and went over 100 pips straight to Thursday's low, Friday and Thursday. So again, think about what's happening. Just because the market moves 100 pips does not mean that you had to be in that move. The next criteria that you're thinking to yourself is that, are they working the low? Because as we head into the next session, we could see an even bigger trade going the other way. The first target's going to be the trader who's in the money from the London session. And that's so important to remind yourself to not chase trades. You're not missing out. We're going to get another big move today probably. So think about what's happening, stick to the timings, and then understand that in most cases, these trades are going to be coming off of round numbers. Gold went up 25 pips above the 100 pip box to stop out the trader from Friday night's US session, dropping down. The pin hammer came off of round numbers and it accelerated through the 100 pip box and pushed down underneath 25 plus below the 00 box. So again, and culminated at 50. So engulfments, lock in the high. Another question I received is, can you differentiate between a pin hammer and an engulfment? An engulfment by itself, a pin hammer by itself, does not necessarily mean we are at the high. What's critical is what time is it? Is it a stop hunt, or are we stop hunting back inside of a trend? All of these things. So yesterday the market blew off into that third hour, pulled back in the equities, hit it again. So a pin hammer by itself, depending on the time, if it was at the end of a move after 3 hours of drop or the equity hour extending out, once the low is there, we want to watch how price behaves. So if the pin shows up, the pin by itself, if it's been a 1, 2, 3 after we've seen the market trend, a 1, 2, 3, this could be. But what we want to see is how does the next candle beside it behave? If it's an engulfment, that may be our trade. But a pin hammer by itself in the middle of nowhere may just be part of a continuation move. So it's very important, if you don't understand, print off your charts and study what they look like. Know what time it is. Know, are we at round numbers? Is there a previous boundary there from yesterday's high or low? Is there any other significant price boundaries there? How does price behave in the next bar? Remember, we want to see the market move and then go into consolidation, even if it's a 3-bar pattern. A 3-bar pattern is what you'll often see reverse these moves, as we saw in the pound last night. So again, we're going to examine those charts. Engulfments, pin hammers, 3 pushes, jamming them into a peak, whether they're extended out, whether it's jammed in for a squeeze, whether it's 3 pushes over 3 hours, as we saw in gold last night. And then a 1, 2, 3 often will be the stop hunt to end the move. Again, we saw that at the beginning of at the end of the Asian session, just prior to the move in Europe for gold all the way down. 1-bar stop. Somebody asked me what a 1-bar stop is. If you're at the high or the low, 1 bar. 1 ATR, doesn't matter. They're both about the same. 1 average true range of the 15-minute charts. Depending on how big the candle is, it could be 20, 25 pips. Usually that will be enough. If it goes further than 25, depending on where your fill is, we could be into the next quarter level, which means you could be caught in a measured move or in a market that you've gotten in too early and they've still got another 25 to 50 pips perhaps to extend that move out. So when I have a 25 pip stop, remember, risk management is the only thing that will ensure your success. If you execute your edge properly, risk management is what's going to ensure your success over time. And again, coming back to executing your edge, back testing, all these things, understand exactly what it is that you're looking for and understand how you're going to process the information in live time. The way that I do that is that I focus on 12 candles, and I am very geared to the movement of the clock in 15-minute cycles. And I've talked about looking at smaller time frames at peaks on 1, 2, 3s when I'm at round numbers for evidence of that being locked in on the smaller time frame, whether that's a 3-push pattern, whether it's an engulfment for an M or a W, second leg. But I'm only looking at that in that upper 25 or lower 25 pip box at the end of the timing window in that equities hour, specifically if we're in New York. New York, 90% of the time will take traders back into the wrong direction in the equities hour to the high or to the low before they lock it in and then shift the market 50, 75, maybe 150 or more pips. And when they lock that in and they move it, it moves very quickly. Remember, coiled markets explode for big moves. 3-push patterns will blow off in the direction of the trend, or if it's a squeeze, boom. Like we saw again on gold last night, explosive moves. The longer a market coils into that 12 candle window, the more high probability opportunity we have building up for us. So again, if you think you've missed the trade, you didn't see it, you took off without you're chasing it, remember, that's a stop hunt as well. They're going to the previous day's high or low. They already triggered orders on Friday from Thursday's high with payrolls, so they're going back down there to hit stops, first of all at the low of the day, especially if traders have moved a trailing stop below the day's lows. So again, thinking about what's happening on those larger time frames and what happens when they trigger those breakout orders. Stop hunt, trap, trade. Let's break it down. We'll look at a blank chart and then we'll look at the timings, the round numbers. We'll look at the engulfments, pin hammers. We'll look at 3-push patterns. We're going to look at 1, 2, 3s. They were all on those charts yesterday. Congratulations. A lot of traders, I think, made a killing yesterday. And again, best playbook setup. Print those off. Those patterns will show up in different variations every single day. Same type of opportunities. 3-push patterns, 1, 2, 3s at the timings, hitting stops. stopping out traders who are in the money, moving the market to the other side, coming back and getting the traders who are in profit from the big move. But again, three things that markets do. They break out, they pull back, and they trend. They break out, they pull back, and they reverse. And they break out, and they pull back, and they go into a trading range. But the number one name of the game is where is the money, because that's where the market's going to go. So if you get caught inside, especially in the gap times or anything else, and you're not at the high or the low, you could now be getting chopped into this meandering market. This morning's a great example. The market 1, 2, 3 on the smaller time frame hits the stops, and in 7 minutes moves 25 pips. Some traders are emailing me and saying, I don't see how you can get the 25 pips. Where do I get in? There's 20. If you're in a market for longer than an hour and it's not up 25 pips, there's a problem unless you're on a third leg and they're consolidating for a big move in the opposite direction. But if you're in a market that's not moving in your direction or in your favor within the first 15 to 30 minutes, even if it's consolidating, there's a problem with that trade. So let's take a look at the charts, traders. Again, thank you for a ton of great feedback. Thank you for hitting the notifications button. And thank you for the likes, because again, I'm trying to show you what's happening in live time, what's real every single day. A lot of traders are picking that up. Step back, stay on the outside. Don't worry about chasing stuff. If you don't see the trade, don't feel like you've missed out. There are plenty of other opportunities. There's more than 50 pips a day here. There's a lot more than 50 pips a day, but if you master 50 pips a day, 50 pips a week, if you master that at size and build size up through consistency and through your results, through your discipline, through your patience, through your execution of your process flawlessly, there's no limit to how big you can build your trading business. So again, stay disciplined, stay focused. Let's look at some charts. Let's break it down into some very simple steps. Again, high and low of the day. Today's high and low, inside or outside, the timing windows, round numbers, engulfments, pin hammers, stop, hunt, trap, trade. Where is the money? Have a great trading session, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading, and today just going back through and looking at some best playbook trade setups. And if we go back and look at Friday, so again, this is payrolls on the British pound. We've talked about a day zero scenario where the market puts in a peak formation low and a high and locks in traders inside on both sides before going into consolidation in a narrow range or in a tighter than normal range. So we have Friday's low and we have Friday's high, but we have peak formations on both sides. So we have the peak formation high, we have the peak formation low. This is the telltale sort of designation when the market's in a horizontal range, locks in the low, locks in the high, and goes into consolidation into the close. But what's significant about this is that as we head into the new week on the Monday, the market right off the bat is working the low of the box. So again, if we have a boundary, and again, we just think in simple concepts, we talk about prices in a box. There's your box. There's the high and the low of the box. If you're at the low of the box, we either are buying low at the timings with the correct indication for buying low, whether that be a squeeze, a three-push pattern, three pushes culminating in an M or W formation, whether that's a type 3, type 2, type 1, or we get a breakout of a trading range, which is our structure, our geometry. And again, people read Peter Brandt's book, read Schaubacher, read Edwards and McGee. Schaubacher's book's almost 100 years old, I think. So for people who come along and think that somebody just magically wrote up a course in the last few years and figured all this out, all of this stuff has been around for since the beginning of markets. So, there are people out there who are promoting that they've discovered this and it's their material and everything else. But unfortunately, the markets are the markets, and they've been around from day one, and they will continue to do what they have always done. So just looking at the blank chart, we can see that the market put in a high of the day prior to our Europe London 12 candle window, which we will look at. But again, just the understanding that we have an engulfment of a high bull candle, a peak formation structure, a high bull. So we'll blow this up. The highest bull candle, the market's going higher. 1 push, 2 pushes, and then a 1-2 sideways 3 before going sideways with a 1-2-3 bear candle formation, and then engulfing. So as we head into the next session, we have a high of the day, we have a low of the day, which with this gap, this is the same as a bear candle, but we also understand that that low is from the peak formation low of Friday's session. Now, if we bring our chart even tighter and look at the week, we can see that we have an anchor point low. So for people who say, what's this anchor point you're talking about? And I've never heard of it before. Well, it's an anchor point because the market works up in pushes and eventually builds sort of like the peaks of a house before rolling over and hitting the stops. And the reason, again, remembering why the market will want to come back here, and that's probably because there's money sitting there. So again, I talk about where is the money? Well, if the market's rolling over and putting a high of the day in place, there's going to be money here when it goes up and the next day takes out the high because traders are short somewhere coming into the close of this session off of 3 peaks. We know there's money up there. We know there's money down here the next day. And we know there's money here when the market goes down in London and forms 3 pushes. So again, we're going to, for people, again, this is a great example. We'll just come back actually and redraw Thursday's low so traders can see that as well. We have Wednesday and Thursday's low. But the market comes down, and in our third hour, 1, 2, 3, these 3 candles are our third hour. And when I've talked about this, when you get a 3-bar reversal from the same hour and the next candle breaks that high, or if it was in the peak formation at the top, this is essentially now a 1-hour pin bar. When this candle closes, this 4-bar structure is a 1-hour pin bar. Okay, but this 3-bar reversal, because of the timings, so the equities hour comes down and continues to extend. There is no evidence of going long here anywhere. But when we get down here and the market goes 1, 2, 3 in the third hour, first candle, second candle, third candle, and it breaks the high, we now have a 1-hour pin bar after we've taken out Wednesday and Thursday's lows of the day, as well as Friday's. So we have a high of the day, and now the market potentially may have a low of the day in place. So we have a low, but now we want to know, are they working the low or are they working the high? Well, for all intents and purposes, this certainly looks like to me like they're working the low of the day prior to heading into the next 12 candle window. They're working back down into the peak formation. They don't have to go through the peak formation, but they're working back into that 1-hour lower bar, which again, our low bear candle. We said we had a high bull candle. Now we have a low bear candle. The market formed a 3-bar reversal in the third hour. They broke through that in the last candle, and then they layered on top. 1 push, 2 pushes, 3 pushes down, breakout candle, and then into our 12 candle window, 1, 2, 3, pinning into traders who are long off the bottom. A third and final time as the 12 candle window for the US session opens, and we'll look at the colorings in a second. But again, remembering that we have traders in the money up here, and the market will go back to make sure that traders either get stopped out at break even, with a loss, with a small profit, whatever that may be, but they will do everything in their power. So again, they put in a peak formation and then they work back into it. They're jamming in there because they're filling it in, making sure that nobody who's long gets a chance to take anything off the table. They get shaken out of the trade. They can't go to break even. If they go to break even, they get them again, stop them out so that when the market pulls away, they don't have any money in their pocket. But the smart trader who sat through this before, if they got in down low, they're sitting there with their 1-bar stop, whether they got in here, anywhere in here. they have a 1-bar stop because we have essentially a 1 ATR range at the bottom of the market. If the traders got in somewhere down here on the break, they may have gotten in at round numbers, which again we'll look at. We'll bring this chart up. So painting a different picture on this now, we have the previous day's low. We have round numbers, okay, at the very beginning of the Europe London 12 candle window. We have an open drive after breaking out of the previous day's range. The minimum I would expect this market to go, forgetting about any previous day's lows or highs, is a measured range expansion of this geometry itself at a minimum. The other option is one full expansion of Friday's range, which we see we hit that. But the simplest way to do this without this tool, if you have round numbers on your chart, is just looking that the market was in a 50 pip box. It's broken into double zeros. Clearly it's moving more than 50. It broke through down to the double zero box. The minimum I would expect out of this is another 50 pip box. And again, coming back to understanding that extra quarter, these 3 bars, the last hour of the 12 candle window extended, was the 25 pip extension outside of your 50 pip box. So similar up top, the market went 25 and tried to go another 25, but it failed just above the quarter level before rolling sideways and dropping down inside. So that quarter extension above the double zeros was our area for trapping volume before the market shifted away. So again, counting pushes, we can count 1 push, consolidation, 2 pushes, consolidation, and then a 1, 2, 3 to end the move. Regardless if it's a bull candle or bear candle, we have a lower high and a lower low, and then the market engulfs. Third candle of the third hour, and the break of that bar makes this a 1 hour pin bar. A pin on the low of the day after taking out Wednesday, Thursday's lows of the day. So again, remembering the psychology we talked about, there are stops placed above and below daily lows for breakout orders, trailing orders, whatever they may be. Larger funds may be trailing a 2-day stop, whatever that may be. But this washes them out, and then we get 1 push, 2 pushes, 3 pushes to end the move. We get our sloping, shortened type 2 W, at the low of the day. The market breaks above the pin hammer, breaks out for 50 pips, and then pulls back 1 sideways, 2, 3, and continues the move in our third hour for a measured move back to where the original profitable trade is in London. So again, coming back to understanding, if you weren't in this move, you got to start thinking that's okay. The more this moves, you still have the potential to either be in a trade back, or if the market was pulling back in 3 pushes heading into the US session, we may be in a measured move down. So there could be another 100 plus pips down if the market set up slightly differently, working back in without a peak formation and consolidating, and then continuing the move, which we will usually see underneath of a previous day's range. So if we take a look at gold, again, very similar to the pound, we have a day zero sort of scenario. The market went into consolidation after 3 days of rise, and we have payrolls wicking both sides, and then working the high into the end of the equities hour. Then we got an inside bar, and then the move down through the low of the day. Now again, coming back to just looking at blank charts to understand the high and the low, the concept of the high and the low. There's a box, but we also have traders who are in the money. So there's our box, and we have profitable trade from Friday night, and we have traders who have potentially gone long after 3 pushes into the low of the day and the engulfment of the low bear. Even though there's a bigger bear candle there, we take the small bear inside of the pin because that's where the engulfment candle moved for the long trade and is still, until the rollover, still in the money. And as you can see in the rollover, they came down 1, 2, 3, pinning into this trader who was long. So then our other trader who's short from payrolls is still in the money. He may be a target. And as we see the market drop down 1, 2, 3, came back, and hit the high. Pulling back, they hit the high again, 2 pushes. And then pulling back, and towards the end of Asia, we get a break of that with a 1, 2, 3. Again, understanding that this trader was in profit. The market has gone up there. It doesn't have to go right into it. But we get a 1, 2, 3, and then an engulfment prior to our Europe-London 12 candle window. So we have our high bull. And the market drops down, engulfs, and goes sideways, and then comes back 1, 2, pinning into traders who are short, the first mouse, but that also gives us our middle structure. So again, for traders who ask, what is a middle structure? If you have an M or a W on a third leg or 2-push pattern, whatever that may be, you need a middle. That's what makes it an M, and that's what makes it a W. So if there's nothing here in this initial movement and you're shorting this, remember the market will need something to come back to hit stops or to trap traders. So until we get that swing, now we have a middle structure. But then we also have, after our right shoulder comes down and engulfs the middle structure, we have our pin hammer. So again, coming back and understanding that these setups will show up every single day in different variations. 1 push, 2 pushes, 3 pushes ending on a 1, 2, 3. And also we have on that 1, 2, 3, 1, and then 2, and then a 3, which gives us a 33 on our third leg. 3 pushes on our third leg before we get our final engulfment and our pin hammer. And not only a move through Friday's low, but Thursday's as well. So we have Friday's low taken out, which obviously it blew through and pinned right through to Thursday's low. So again, just the reason I'm using these blank charts is to paint some simple concepts. We haven't even looked at timings yet here, but these are all in the timing windows. But then we get our pullback and engulfment, which now forms our low of the day. So again, understanding that just because we have a low of the day now does not mean that that itself is a trade. We have a low of the day as a reference now. We're outside of our 12 candle window, but we want to be thinking, are they going back up or are they working the low? Well, clearly they're working the low. 1 push, 2 pushes, 3 pushes, breakout. The pin is a pullback pin hammer. There's our middle structure, our third leg. Pin hammer. This 2-bar structure is our pin hammer. We'll blow that up for people who may not be able to see that. Regardless if it's that little bull on top of the pin, that's a pin hammer. After 1, 2, 3 pushes, engulfment, pin stop hunt into traders who got in on the inside bar, which several traders told me they did, knowing that they would be retested. Inside bar, the pin comes back. If you go to a smaller time frame, you'll see the opening stop hunt was down into the inside bar before pulling back, giving us our little bull bar on top of the pin, which some traders would want to short. But again, we're in a squeeze. You do not want to short into a squeeze if it's a bear squeeze. So then the market explodes, and not only do we get a stop hunt back to the high of the day to the profitable traders, but we also get our measured move. We clearly had more than one full expansion and almost 1.5 full expansions. That market moved 300 pips roughly. So again, if you've missed this, that's okay. The pin and then the low of the day being in place tells us now, coming into our next session, we watch to see how does price behave. Does it race back up and work the high for a stop hunt down or a breakout? Or does it come back down into the peak formation low? 1 push, 2 pushes, 12 candle window, 3, breakout, pullback, pin hammer, an explosive move. Traders made more than double up than what traders made down. So there's plenty of opportunities. And again, the 1, 2, 3s. There's 3 pushes, 2, 3, and there's 1, 2, 3s. And then there's 33s, 1, 2, 3, and then this first leg, second push, and a third push on the third leg is a 33. We have an engulfment. We have our right side of our M, and then we get our pin hammer for the fast. Traders are in this market, if they're in here somewhere, maybe 5 hours for 25 pips maybe. This market goes 100 in 1 hour. So this is, again, understanding these compressive coiled markets will explode and give traders lots of opportunity, which is why I don't trade in the gap time, which is why I mainly focus on the opens, which is why I set my profit targets, and in some cases will have a second position to let run. But there is plenty of opportunities in these markets. You have 1 bar stops, whether you're selling, going long, asymmetrical risk reward, round numbers. So again, we'll look at this on the normal chart. Market pushed up 25 pips above the 00 box to get traders who were short from the U.S. session close. Sorry, the U.S. session equity hour. We get our fast stop hunt down through 50, pinning 25 pips below that 50 pip box before pulling back above the 00s and working back into the numbers for 3 pushes before inside bar pulling off the 00s, breaking out, pinning down one last time, pin hammer for the explosive move back up. Again, 25 pip extension past the 50 pip box, a little bit further, but again, that 25 extension past the box acted as our buffer zone for trapping volume and finishing the move. Keep it simple, traders. Work from the high and the low. Where are the profitable trades? The timing windows, engulfments, pin hammers, 1 bar stops, presetting your profit targets, locking in the money, coming back for the next session. Zero stress trading. Keep it simple. Have a great trading session. Hopefully you got value out of today's video, traders. Keep it simple. If you're on the outside, at the high and the low, there are plenty of opportunities.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.